Ever wondered what makes the stock market tick? Well, let's delve into the intricate world of the stock market together. At its core, the stock market is a public marketplace for the buying, selling, and trading of company stock and derivatives. It is where companies raise capital to fund their operations and future growth by selling a portion of their ownership in the form of shares. Think of the stock market as a grand auction house, where investors from all walks of life, individuals, institutions, even governments, bid on the prices of stocks based on their perceived value. The higher the demand for a particular stock, the higher its price rises, and vice versa. Now, to facilitate this grand exchange, we have something called stock exchanges. These are regulated platforms where stock trading takes place. Some of the well-known stock exchanges include the New York Stock Exchange and the Nasdaq. They act as a meeting place for buyers and sellers, providing a transparent and orderly process to execute trades. The stock exchanges also maintain and regulate the listing of stocks, ensuring companies meet certain requirements before their shares can be publicly traded. This is to protect investors and maintain the integrity of the market. Another key function of the stock exchanges is to provide real-time trading information. This includes the price of each stock, the volume of stocks traded, and any changes in the price. This information is crucial for investors to make informed decisions. Now you might wonder, with thousands of companies and numerous stock exchanges worldwide, how does one navigate through this labyrinth? Well, that's where market indices come in. These are essentially a summary statistic that reflects the overall performance of a group of stocks, giving investors a snapshot of the market's overall health. So the stock market is essentially a marketplace for investors. But how does one actually invest? Well, that's a fascinating journey we'll embark on in our next scene. Stay tuned. Stocks, the heart and soul of the market. But what exactly are they? Let's dive right in. Imagine stocks as tiny slices of a company. When you buy a stock, you're buying a piece of ownership in that company. It's like having a sliver of a gigantic corporate pie. This ownership gives you certain rights and benefits, like voting on important company decisions and receiving a share of any profits, also known as dividends. There are different types of stocks you can invest in. Common stocks, as the name suggests, are the most common type. They come with voting rights, but also put you last in line if the company goes bankrupt. Then there are preferred stocks. Preferred stockholders don't usually get voting rights, but they do have a higher claim on earnings and assets. This means they get dividends before common stockholders and have a better chance of getting their money back if the company goes under. Now, you might be wondering how the price of a stock is determined. It's all about supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. But what influences this supply and demand? A lot of factors, from the company's financial health to economic news to market sentiment. Even rumors can send a stock price soaring or plummeting. But remember, stocks are not just about making a quick buck. They represent a long-term investment in a company and its vision. They're about believing in a business and wanting to be part of its journey. They're about sharing in its successes and weathering its failures. So when you're buying a stock, you're not just buying a piece of paper. You're buying a piece of a company's future, its risks, and its potential rewards. You're becoming a part owner of that company, with all the rights and responsibilities that come with it. Stocks, then, are more than just pieces of paper. They're your ticket to becoming a part owner of a company. Ever heard of the Dow Jones or the S&P 500 and wondered what they mean? These, my friends, are what we call market indices. They're like the pulse of the stock market, giving us an idea of its overall health. Let's say you're trying to understand how well the American economy is doing. You could look at every single company's stock, but that would be like trying to count every fish in the ocean. Instead, you could look at something like the Dow Jones Industrial Average or the S&P 500. These indices take a sample of major companies, and their performance gives us a snapshot of the broader market. The Dow Jones Industrial Average, often just called the Dow, is one of the oldest and most frequently used indices. It's made up of 30 large, publicly owned companies based in the United States. The S&P 500, on the other hand, tracks the performance of 500 of the largest companies listed on the U.S. stock exchanges. But how are these indices calculated? It's not as simple as adding up the stock prices and dividing by the number of companies. Each index has its own method. For example, the Dow is price-weighted, meaning companies with higher stock prices have a greater impact on the index's value. The S&P 500, conversely, is market capitalization weighted, so companies with a larger market value carry more weight. These indices aren't just for show. They can be used to gauge market sentiment. If the Dow or S&P is up, it generally signals that investors are confident and buying stocks. If they're down, it might mean investors are feeling bearish and selling off their stocks. Market indices can also be valuable benchmarks for investors. They can compare their own portfolio's performance to these indices to see if they're outperforming or underperforming the market. So when you hear someone talking about the Dow or the S&P, you'll know they're referring to these vital signs of the stock market's health. Market indices, then, are the compasses that guide us through the vast ocean of the stock market. Buying low and selling high sounds simple, right? But there's more to stock trading than meets the eye. It's a thrilling world that blends strategy, foresight, and sometimes a touch of daring. Let's unpack how trades are executed. Imagine an intricate dance where buyers and sellers, guided by their own strategies and motivations, meet in a marketplace. The stock exchange is that marketplace. Here, brokers play the role of choreographers, stepping in to connect buyers and sellers. From individuals to institutions, brokers are the vital link that keeps this dance in motion. Now, onto the types of orders. There are market orders where you buy or sell a stock at the best available price. Then, there are limit orders, where you set a specific price at which you're willing to buy or sell. Each order type has its own benefits and trade-offs, and the choice depends on your trading strategy and risk tolerance. Next, let's talk about liquidity. A stock is considered liquid if it can be quickly bought or sold without causing a significant price change. This is crucial as it allows traders to enter and exit positions with ease. In essence, liquidity smooths the path for the dance of trading. But trading isn't without its risks. Just as a dancer might stumble, so too can traders. The stock market is influenced by myriad factors, from economic indicators to global events. That's why diversification is key. By spreading your investments across different stocks and sectors, you can cushion the impact of any single stock's poor performance. Trading is a bit like chess. You need to anticipate moves, react to changes, and keep an eye on the bigger picture. And just like chess, it requires discipline, patience, and strategy. It's not about making a quick buck, but about understanding the market, learning from your mistakes, and continuously improving your skills. Stock trading, then, is an art that requires knowledge, skill, and a little bit of luck. So we've navigated the labyrinth of the stock market. Now what? Well, we've covered a lot of ground today, from the basic building blocks of the market to the art of stock trading. Remember, the stock market isn't a place where you can just dive in headfirst without understanding the water's depth. It's a complex beast that requires a nuanced understanding to tame. We've learned about market indices, their importance, and how they give us a snapshot of the market's health. We've also delved into the world of stock trading, exploring strategies that can help you navigate this intricate world. And with that, we draw to a close. The stock market, then, is a complex yet fascinating world that rewards those who dare to understand it. Enjoyed our journey through the stock market? It's a thrilling world, isn't it? And staying informed is key. So dive deeper, explore further. Stay tuned for more insightful journeys into the world of finance. Don't forget to subscribe and like